Our guest, Marshall Mays, Director of Emerging Alpha Advisors, on with us today. And I want to kick off this conversation talking about the credit default swaps. What exactly is a credit event in your view?
Well, there are actually about 10 points that are agreed in the standard structure for what it defines. However, we've learned that politicians who survive by changing definitions have been very good at doing that to
is
CDS.
Greece a credit event?
In my book, it was a credit event a year ago.
No, it isn't. Of course it isn't, because that was a ruling saying that it wasn't, so it can't be.
There you go. There you go.
ISDA
There you go.
anyways.
But, no, they must. I mean, people who have been affected by this, and they've been. I mean, we had such as your dad's talking about this earlier, saying, well, it is a credit event because at the end of the day, this voluntary haircut is about as voluntary as gaining questions, well, answering the Spanish Inquisition, what he was saying, right? Now, surely people are going to get upset, and there are going to be some litigation.
Well, there's a question of public policy. Are you more interested in making sure the CDS market works as a liquid hedge against risk, as a means of telecommunicating through the market the value of credit instead of just keeping it in the bank? Or are you interested in the euro being stable and solid, or the We Love Germany club sticking together? I mean, these are big questions, and who is the biggest one in the room changes by the week, I think.
What are the repercussions? I mean, have you ever bought a CDS? I mean, would you ever buy a CDS?
Yeah, with this in
future?
mind, would you be totally put off buying them?
Basically, a CDS is meant to be insurance. If you buy insurance against a bad event because it's mispriced, you're basically saying the market is not understanding the risk, and therefore you'll game it. The problem is that they may be correct and you may be wrong, or they may say, we don't like this outcome, we'll change the rules. So if you trade in the edge of risk, you're likely to be caught by the rules, not by the contract.
And have you ever bought a CDS, though, yourself? You've never owned one? Never looked at those instruments?
Well, I've looked at them. I've looked at a lot of them. And I frankly think they're probably 20% of the market might be worth buying. But basically, they're so well priced, why would I buy them? I mean, I basically make the intention of selling mispriced and buying mispriced instruments.
If you take a look at some of the bond yields, Spanish bond yields, Italian bond yields have actually been down. But how much of a problem is it the fact that, all this cheap money, this $1 trillion in euros is flooding the market? To what extent are we actually going to feel that effect later on? Well,
this is, in a sense, a carry-through mechanism, just like the Resolution Trust Corporation helped the Americans get out of their savings and loan debacle 15 years ago. The difference is that the taxpayers have no vote on this, whereas in the U.S. they did have a vote on it. So there's a little bit of buy-in, if you will, by the general public. In both cases, the state is carrying through this situation until the market wakes up and gets on its drugs and starts to think about things in a positive fashion. The problem is it could take a long time because the problem is so big. And leading your answer, the longer you stay on antidepressants, the less realistic you get about what it is.
So this deduction in these bond yields, is that artificial to some extent?
Of course it is. I mean, the entire structure is artificial. It's trying to make a compromise between earlier contract and what is politically feasible.
How do you explain, Marshall, this week Asia entered a bull market territory in stocks?
Well, quite simple.
11 weeks in a row, and there are all these crises and concerns and 14 trillion of debt in the States.
Beginning of the year for bonuses, everyone's allocating to the quick hit. Obviously, a momentum rush. Asia's benefiting from momentum play. If you look at
it's a record run, 11 weeks.
Doesn't matter. If you look at the price-to-book ratio across any spectrum of the market, it's a spike up, which says purely a psychological spike, which means it's an asset allocation, not a trader's spike. But still, the books will rotate back out. So traders rotate in one day. The book rotates in a month.
So you're going to be getting out of asset classes, going to be shorting the market now? What are you going to do?
Hedged out.
You're hedged, are you?
How do you find alpha in these markets? I mean, that must be pretty hard to beat.
No. As soon as you move away from the top 5 or 6 stocks in any index, dispersion gets huge on what it really means because information coefficient goes way down. That's where you get alpha.
But isn't this year more about beta than alpha?
No. Beta is about leverage. And if you're in leverage in this market, you're stupid.
Oh, really? Oh, there you go.
Okay.
So don't borrow.
All those people in leverage.
Also, I mean, the money is in dairy farms.
There are many businesses which are about,
safe.
There are many businesses about nuts and bolts. Well, it's not safe because it has political risk, it has human error, process error. It's a different sort of risk. The trading environment assumes you have good information, the market has bad information, and you act on that. Whereas other businesses, which make a good return right now, the real sector, are based on changing people's attitudes, slowly improving process, squeezing efficiency out. It's getting up every day at 6 o'clock and going to bed at midnight, again and again and again and again, no stop forever.
Well, talking about change in attitudes, commodities are at a 10-month high. To what extent is that going to continue that rally?
Well, that's based on the fact that the market knows it's flooded. Asset prices are going into consumption as well as to stabilizing bond markets. And as long as that support consumption is there, it will keep commodities levitating.
That support you're talking about
So
really
Middle
driven
Eastern
from
West.
Asia,
Well,
right?
it's basically
Iran,
China,
Better
United
than
States,
expected
Europe.
Chinese manufacturing numbers really helping
Well,
the
that's-
commodity boom, the
That's-
metals boom.
Well, the better numbers are based on, again, this support, state support. So the state is stepping in quietly, not too aggressively right now, to keep things from falling apart. So it supports demand. As long as you support demand, the level we've had for the last 4 or 5 years, with the exception of 2009, commodity prices will be high because getting them out of the ground is a big headache. I mean, 2 or 3 years, they'll be out of the ground, prices will be back down. But if you keep supporting the market and all of a sudden you have some miracle, nascent, self-generating growth,
Right.
not like them for a few years, but if that happens, then you can expect...
Very quickly, John's got a question about dairy ambitions.
That was it.
Yeah?
That was the question.
What's that?
Dairy ambitions.
Well, it's on milk farms in the Philippines.
Yes, yes.
But you're saying there is risk, but there is not as much risk, perhaps,
Well, it's a different type
as
of
it is
risk.
investing in this market.
It's a different type of risk because it's a
you
slow
making money?
I
management.
wonder what milk is trading at.
Milk farms in the Philippines.
Yeah. What's cattle trading at?
Organic growing. Yeah.
The nature of dairy is that for the first year you buy into capital, you basically have negative carry because you have to get the animal to have a calf. As soon as she has a calf, you're in business. And we are now in business.
Are you making money, Marshall?
Yes.
Are you making money?
Yes, and that's what's bringing the investors in.
John won't let that one go. And by the way, John, I did ring up the European Central Bank yesterday, and the EFSF is not available to individuals. Just thought I'd let you know. Yeah,
Why are you asking me that question? Man, all is good.
Yes.
Are you saying he's desperate for leverage? You know?
Fine.
No, I was just
Oh,
asking.
it's only a Friday.
No leverage.
You're tapped out on your bank line, right?
Year of austerity, no leverage. It's the
Okay,
best way to be.
Marshall, good to see you. Thanks again. Marshall Mays there of Emerging Alpha.